So talking about insurance. So in generally, I just kind of want to go through why insurance is a big leverage point. I know we've had I've had conversations in the past, and I discuss about how, there's the Maslow's hierarchy in a triangle, and the real pivot point becomes there's three things that drive your pivot point as to whether personal, financial, where you're going to get to. Those three things are insurance, taxes, and debt. And that's a reality because they make up such a big piece. And I think people, when they think of insurance, they don't realize how much insurance is really in their life and how much it could be either hurting them or helping them, depending on if it's properly managed and if it's properly run. So let's just kind of walk through all the different areas in which insurance impacts, and we'll be quick about it. So focus on the health insurance. Sure, everybody knows that, you have the health insurance. Most people will get this through work. There's multiple areas where to come through. So focusing, you have your medical, you have your disability, you have your long-term care, you have your dental, you have your vision, you still have others. So there's accident and health, various pieces there. So there's multiple areas in which where insurance will impact you. So what I want to do is focus on a tip for everyone in each different piece. One of the areas where people are often actually overpaying for insurance is they think they have these gold plans that are really strong. But, one thing that you can really look at is these HSA plans. The HSA high deductible plan, people are kind of scared away by the high deductible versus the low deductible. What they don't realize is the amount that they're paying each month, that's gone. That's gone one way or the other. So unless whether you're healthy or sick, if you end up getting sick, then obviously that low deductible plan is great. And if you're really sick, then that low deductible plan is awesome. If everyone in your family is really sick, you made it out a home run by having that low deductible plan. But it's particularly younger, healthier people where you're really just throwing away a part of that money that can be put into a tax deferred plan. So really you're saving it into an HSA account. And if your out-of-pocket expenses are less, that builds and that continues to build and that continues to grow. Reality of COVID has taught us you may not stay with your employer a really long time, but the HSA is yours and the HSA travels with you. So that is something to kind of look at. So again, that's just a quick tip on medical insurance. Life insurance. There's multiple facets to life insurance, and I think everyone's focused, or most people focus too heavily on the legacy piece of the insurance. So the legacy piece is what everyone thinks about with life insurance, which is the death benefit. But life insurance offers a ton of other things when managed properly that can address a lot of other pieces. And when it comes to a financial plan, you really want to have, there's never enough money for everything. I've yet to meet anyone who says, oh yeah, I got money, I can get this, I can get that, I can get that. So what happens is you got to find those Swiss Army knives, those tools in your tool belt that do multiple things. And life insurance could be one of those because of the different areas that can address your long-term care, your income, your security, your flexibility. I'm going to give a quick example of a client of mine, very close. Try not to give too much information away because I am recording this, and it's but someone very close to me got a large, at 28, got a large sum of money from a life insurance policy. So asked, what should I do with this? I said, well, if you're smart, you're going to do exactly what we're going to use this properly. So they got $200,000. They're 28 years old. I said, if you never touch this, if you can work on not touching this money for 5 years, you can have a really good plan. So that's what we did with them. We put it together, created a life insurance scenario for them, and they've been very good about it. For the 5 years so far, they haven't touched it. And that $200,000 that they got from a life insurance policy, it just came to them. It was money that was just literally found money. They were able to, we put together, so it produces about 6% on average in income. That 6% on average in income pays the total premium for a year on a life insurance policy where the death benefit is crazy high that they don't worry about. The death benefit just had to be there so that we can use the other tools. The legacy portion of this policy was not what the focus was. No one really, she didn't really care about the legacy piece. You cared a little bit, but not too much. But what you see is the big difference is this cash value and focus on the income piece. People say it's a horrible investment in life insurance. Well, what it is that tax value. It builds and it accrues and it grows. So by the time she's 20 years in, she's already well ahead on what she's put in premium. And God forbid she dies, it's like the greatest thing that could happen from a return on investment. So from a return on investment, that's happening. But more importantly, we're focused on when she turns 65. When she turns 65, she has to take out $100,000 a year and will still never use up this money. So this is her pension. She literally has a pension of $100,000 a year. Real scenario. She's just a pension of 100. She still has the 200,000 that she could or can spend at any time during that year. We didn't touch that. We didn't do anything with that. She still has that access to that at any time. She has access. This is where liquidity comes in. She has access to borrow against this before she hits 65. But what it's really given her, and this is the thing that I want to focus on, is that strength, and that knowing that has given her the security and the flexibility to be more aggressive in the other things that she's done in life. And she created her own business and has done things. And now she's in a wonderful situation. She's got a big house, she's got things going because she was willing to take the risks because she had the security. And all that came from one tool. And she didn't even thinking about dying. Like that death benefit is nothing. That's not even important. But in the end, her kids are set. So that's kind of something about life insurance, multiple tools, multiple pieces. That's where we talk about leverage, to really use that tool as a way to get you over the hump. Next step is homeowners insurance. So homeowners insurance, everyone has to have a homeowner insurance. There's really things that drive this. And I think this is one of the things that people miss about homeowners insurance is everyone's focused on the coverage. We'll get into the coverage a little bit, but that's further down in the calculation of what your rates come in at. When it comes into rates on homeowners insurance, it's driven first by the property. How old is the property? How insurable is the property? Has the property, whether it was with you or not, if you buy a property that someone else had a big claim against, there's a ding against that property and it shows up on the reports. There's the maintenance and what you've done with that property. Has that property, when's the last time the roof's been done? So those things have a big impact. The amount of claims that you personally have had in the past or that the other individuals had drives it. Then comes the coverage as to what type of coverage you have. And then comes your credit. And then finally is the loyalty of how long you've been with the company. So as you can see, loyalty is not really that big to these insurance companies when you're coming up with your homeowners coverage. And if anyone cared to know, I can get into a little bit. Your dwelling is the coverage of the actual property to rebuild it. That's all they do. They rebuild it. Doesn't mean you're going to get that much in money. That's just the budget you have to do it. Structures, personal property is anything. If you took your house, shook it up, everything that falls out. Loss of use is if you aren't able to live in it. If it's a 2-family rental property, the rent you're not getting, different things. So those are all things. If anyone wants to know a little bit more of the details of what all this is, feel free to reach out to me. Next one is auto insurance. Again, an area where people overpay a lot of times, different things that happen. So what happens is everyone looks at the auto insurance. Obviously the vehicle, yes, the vehicle is the number one driver of how much it's going to cost to insure that vehicle. But then comes their driving record. And when we talk about the vehicle, it's not just the vehicle, it's where the vehicle is in addition to the vehicle. A same vehicle in Newark versus a same vehicle in a vehicle in Newark with certain drivers, companies won't even insure. That same vehicle in Hunterdon County, they're going to write that all day long. So first of all, it's the vehicle and where it's housed. Then comes the driving record, then comes the claims, then it gets into the coverage. So again, people think tweaking their coverage really matters. It's these other factors. The driving record itself, they have these devices now that you put in the car. They're going to assume you're going to get punished going forward. And now you get punished for not participating in these driver programs where they let you put things in. They give you a discount, but really what they're doing is marking it up if you don't participate. There's no reason anymore not to participate. They're going to assume you're a bad driver if you're not doing that. And then credit. Credit has a big impact on how much you're paying for your insurance, because if you can't keep care of your credit, will you pay them? But more importantly, the rest of your life is kind of a mess. They kind of assume in the assumptions. And then comes loyalty. Again, it's all the way at the back when you get to the loyalty piece. Umbrella policies, personal liability policies. And again, this is just a little bit about the coverage. A lot of confusion usually about personal liability coverages. Again, factors that come into play. Same thing. Not every personal liability is the umbrella. It basically protects you. Think of a lawyer policy. It protects you from getting sued, even if it's a liable situation. Other things that happen, protects you from everything away from your home and auto, but it goes over top of your home and auto as well. So big drivers on that are drivers. Who's driving and who's going to be covered under the policy. Properties, multiple properties. Always recommend landlords, renters, people who have rental properties have an umbrella policy, because it'll protect not only your primary but your other properties and you from anything happening on those. It gives you a little bit of buffer. Your claims, your coverage, your credit.
You sell that, Dennis?
What's that?
You sell the personal liability?
Yep.
All right.
We sell the PLPs. The best thing to do is to first quote it with where you get your auto insurance, because it's driven heavily by drivers. So again, you can see that it's the drivers is a big fact. And then there's PLP only companies that'll sell just the PLP policy separate from it. Rate wise, you'll probably get the best rate if you have good drivers and good history with your primary company. So I always tell you, look at your primary company first. If that doesn't work, or if, we look at bundling those two together, and then you can get it on yourself. You get it through a company that just does umbrella policies. So those are your two options.
All right, let's talk this week then, please.
No problem. And then finally, this is the one I love to highlight to people. There's the other insurance. So your expensive toys, your boats, your motorcycles, your motorhomes, all those different things that you have, there's insurance for them. Sometimes they can sit on your homeowner's policy. Sometimes they're better to go to a specialty who just insures that. There's debt, PMI, your PMI insurance on your loans, various different other types of loans that you take out require a policy to cover it. So that's a built-in cost of debt. Again, huge lever by working these things properly. Often if you pay down a little bit extra, you don't need that PMI insurance. You're wasting a ton of money. That PMI insurance is really to protect the other person, not to protect you. Jewelry insurance. A lot of times it's better to have a jewelry policy separate from your homeowner's policy for different items and different rings, because the claim doesn't go against your homeowner's policy. You have your pet insurance, but the one that's really interesting is the products insurance, and I think, how many people there insure their phone? Everybody out there, most people insure their phone. What's very interesting is the amount you're paying on that insurance. If you look at after a year, that phone and what everyone, they sell it, and it makes a ton of sense sometimes when you first buy the phone, when the phone is worth $600, when the phone is worth $500, and you keep thinking to yourself, well, I'm going to have to pay $500 or $600 after the fact to get a new one of these phones. But the reality is, what you're actually insuring is decreasing in value very quickly. So you hit a point where you're paying more than, because the $100 deductible and everything else, there's no way you're going to be able to cover the cost. And what's little known is most insurance companies, if you have a homeowner's or renter's policy, they have something that's called a computer endorsement, where it's only a $50 deductible, and it'll cover all the property in here, all the cell phones. So here, a multi-line plan, $45 a month versus 14 cents a day. So you're looking at it, and then you free up that money that you're wasting in product insurance, and imagine what that could do for you. And people usually spend more to insure their phone than they do themselves, their family, and their future with life insurance. It's mind-boggling. But people often spend more. Their phone is worth more than themselves.
Well, my phone's worth more than my family, so that's
that's it. I mean, that's the reality.
I'm guilty of that. I had insurance on my phone, and then when my screen cracked and I went to get my new phone, which I thought it was like, oh no, your phone's too old, but you're gonna end up paying, so it was like, well, this was a waste.
Yep. There's a point, and that's what I would do with our family. Like we still got the phones around. I'm guilty of it, because again, I had young kids with phones that we thought, they're going to break them, and I don't want to put a claim in. The other thing with it, if it's on your other policy, you get 1 or 2 claims, and then it starts to ding your claim history. So it can cost you more in the long run. But the same thing is, and I switched that off. We literally stopped having we stopped paying for their phone insurance, and we actually bought life insurance policies for them for same money. It was literally the same money to put a life insurance policy after they turned 18. They had a life insurance policy for less than they were paying for their phones. So it's something that it's just understanding how it can really be a leverage tool, and how you can overpay for it. And often people overpay for the wrong types of insurance and underpay for the right type of insurance. And that's it. That's my presentation on insurance. So if anyone has any questions or anything, let me know. I'll walk through for you your different insurances and see if you're over or underinsured and point you in the right direction if I'm not the right direction.
Dennis, question, identity protection, is that wrapped under the umbrella? Or is that a separate endorsement?
You can have it. There's multiple ways you can get it. And again, insurance is obviously insurance is sold on a competitive basis. More and more they have to give away more and more, and they're to get people to try to sign people up. An insurance company doesn't make money on you usually until your third year of going in, but they are so competitive now to drive people to each other. It's like cable. You're going to get better rates early on. The longer you stay, it's going to jack up on you. So the loyalty, again, is not that important. But in your homeowners policies, most have pretty good identity protection. Otherwise, there's identity protection, which would be covered under other. You can put an additional endorsement, but most of those endorsements are all on the best rates that you're going to find. And there's multiple places you can get insurance, but the best rates on that kind of stuff is going to be on a home or a renter's policy. And again, just to talk about, Liberty just seems to be the best in renters, but there's other ones that are, not as good in other areas. But renter policy in particular, if you have really good credit and you're not in a really bad neighborhood, and generally for kids going to school, it's $60 a year. We're talking $5 a month on a rental policy for some basic coverage. I mean, renters policies are ridiculously inexpensive, and they have a lot of the same benefits of a homeowner's policy. And a lot of that stuff is all in your other perils and your other aspects of your homeowner's property.
Thank you.
That's where but you can pay for just, identity protection, but that's in your homeowners. The umbrella policy really protects you from others suing you. So it's an asset protector. So what it does is it basically, and that's the other thing, people come, oh, I needed this, case in point, I need $1 million umbrella policy. Well, how much do you have in assets? Yeah, I barely make it month to month. Well, what are you protecting? You're protecting yourself from lawyers, and lawyers are not going to sue you. Like, theoretically they could, but they're not, if they're not going to get money from you. You got to understand how lawyers work. Lawyers need to get paid. So they're not going to go after you, sue you to try to get $15 out of your paycheck for the rest of their lives because you did something really wrong. So the liability only protects assets that you have. If you don't have assets, then you don't need this huge liability coverage. Realistically, there's other things you can do to get those assets. And once you have those assets, then protect the shit out of them. That's my approach. Any other questions?
Thank you.
Oh, you're welcome.